Snowflake executed a flawless operational pivot in Q1 fiscal 2027. Total revenue reached a massive $1.391 billion, delivering a decisive 33% year-over-year surge. The absolute core of this engine, product revenue, hit $1.334 billion, accelerating 34% annually, driven by a massive influx of AI compute workloads. Professional services provided a steady $57 million baseline. Moving down the statement, gross profit remained a fortress at $926 million, locking in a 67% margin. Against $1.253 billion in operating expenses, the business reported a GAAP operating loss of $326 million. However, true bottom-line execution shines in the net loss metric, coming in at $296 million to represent a negative 21% margin. This is a massive 20 percentage point improvement year over year, fueled by strict cost discipline and economies of scale. Ultimately, non-GAAP EPS printed at 39 cents, crushing the 32 cents consensus. To understand Snowflake's valuation premium, look at the multi-year revenue architecture. Total revenue has scaled with mechanical consistency, but the underlying compound annual growth rates reveal the true story. Product revenue commands a dominant 35.6% CAGR, entirely eclipsing the 19.4% CAGR of professional services. The reason this matters is structural. Snowflake's consumption-based pricing model forces a highly scalable, recurring revenue stream. Every new AI query and automated task directly prints cash without the heavy labor costs associated with consulting services. Snowflake is aggressively capturing a total addressable market projected to hit $355 billion by 2029. This dominance is structurally underpinned by their AI and open architecture engine. Secure, native processing is locked down via Cortex AI and Snowflake Intelligence. Furthermore, the strategic pivot to open architecture utilizing Polaris Catalog and Apache Iceberg actively shatters legacy storage monopolies, transforming massive, decentralized data lakes into immediate compute revenue. Let's break down the four core pillars driving this monopoly. First, product revenue is the undisputed cash cow, generating $1.334 billion at a 75% non-GAAP margin. This rare growth reacceleration is happening because Snowflake is successfully monetizing AI workloads on top of their core data engine. Second, the enterprise customer base is the defender. Net revenue retention has resumed its upward trajectory to 126%. This proves that the macro cloud optimization headwinds are officially over. Corporations are unlocking their budgets for generative AI. Third, future commitments are the high-growth bet. The $9.2 billion RPO is fortified by a landmark $6 billion AWS infrastructure deal, guaranteeing cheaper compute power and protecting their 19% adjusted free cash flow margin. Finally, the AI ecosystem is the growth engine. With over 13,600 active accounts and 42% engaged in data sharing, Snowflake has created an uncopyable, deeply integrated network effect. While current revenue pays the bills, remaining performance obligations dictate the future. Look at the parabolic curve. From $2.61 billion in early fiscal 23, the backlog has expanded roughly 3.5 times, compounding at a staggering 37% rate to reach $9.20 billion today. Why is this backlog compounding so aggressively? Because chief information officers are no longer just running isolated AI pilots. They're signing massive, multi-year capacity contracts to guarantee infrastructure access for autonomous agents. Crucially, 50% of this $9.2 billion backlog will be recognized as pure revenue within the next 12 months, cementing an unbreakable near-term floor. True platform dominance is validated by who is actually buying. The onboarding velocity across all tiers is accelerating. Total customers surged 22% to reach 13,912 accounts. Within the elite global footprint, Forbes Global 2000 customers grew a steady 6% to 813. But the absolute gold standard for institutional growth is the $1 million plus product revenue cohort. This segment exploded by 29%, expanding from 604 to 779 enterprise whales. The analytical driver here is land and expand execution. Once a Fortune 500 company anchors its core data in Snowflake, the friction to activate Snowflake intelligence and Cortex AI is zero, rapidly multiplying their lifetime contract value. The 2030 roadmap represents a violent paradigm shift. Snowflake is evolving from passive storage into an autonomous control center for the agentic enterprise. Management is deliberately sacrificing roughly 10% of legacy storage revenue to fully support the Apache Iceberg open format. The reason? Destroying storage lock-in instantly converts massive data lakes into an explosion of high-margin compute execution. This pivot is a direct counteroffensive against Databricks, who is relentlessly accelerating with a $5.4 billion ARR, compounding over 65% year-over-year. While Databricks pushes the engineering-heavy lake-based architecture, Snowflake is weaponizing near-zero management through Cortex AI. They're locking down a highly secure, walled garden purpose-built for strict, compliance-heavy sectors like finance and healthcare. To fortify this ecosystem, Snowflake is deploying universal governance. The Horizon catalog enforces strict access controls, while the open-source Polaris catalog directly challenges Databricks. To secure autonomous agents, the Natoma Gateway neutralizes shadow AI by strictly verifying identity on every single tool call. Simultaneously, AI guardrails utilize specialized LLMs to actively intercept and destroy zero-day prompt injections. This unbreakable architecture justifies a hyper-bullish financial trajectory. The addressable market is projected to explode to $342 billion by 2028. The long-term model targets 80% gross margins and 40% free cash flow margins. By compounding revenue at a 25.5% rate under the high case, hitting $15 billion by 2030, Snowflake is engineering a direct path to a $300 billion market capitalization. Wall Street demands growth, but it rewards operating leverage. Total operating expenses have expanded to $1.253 billion, but the internal capital allocation tells a story of ruthless efficiency. Research and development is compounding at a massive 37.1% rate to build the AI war chest. Sales and marketing tracks at a sustainable 24.6%. But look at general and administrative expenses, contracting sharply by 38.6% year-over-year. The strategy is clear. Management is actively starving corporate overhead while injecting every available dollar directly into engineering and sales. This is how a hyper-growth tech company prepares for maximum profitability at scale. During the cloud optimization cycle across fiscal 24 and 25, net income margins were brutally compressed, bottoming out at negative 41%. This was a direct result of massive upfront capex required to secure GPU clusters for the AI pivot. But the supercycle has inverted the trend. As quarterly revenue scales toward $1.4 billion, the net income margin has recovered violently, stepping up to negative 21%. The heavy lifting is done. High-margin AI compute consumption is now rapidly outpacing fixed infrastructure costs, driving the business straight toward GAAP profitability. When a structural technology shift takes hold, legacy forecasting models break. Snowflake delivered an unbroken sequence of revenue beats, culminating in a massive 5.1% top-line blowout in Q1 fiscal 2027, reporting $1.40 billion against a $1.32 billion estimate. Driven by this momentum, management officially hiked full-year product revenue guidance to $5.84 billion, locked into a raised 31% growth rate. Wall Street is now forced to aggressively remodel its projections. Consensus estimates are charting a steep upward trajectory, targeting $1.48 billion in Q2 fiscal 2027, scaling to $1.57 billion in Q3, and hitting $1.65 billion by Q4. This continuous expansion proves that enterprise AI compute consumption is compounding at an unprecedented pace. The earnings per share momentum completely outpaces the revenue curve. Q1 fiscal 2027 reported $0.39 against a $0.32 estimate, delivering a historic 21.9% earnings beat. This aggressive bottom-line outperformance is directly tied to gross margin optimization via the new ARM Graviton server architecture, which radically slashes data processing costs. The sheer velocity of this earnings expansion has forced Wall Street analysts to rip up their forward models. Consensus forecasts are being hiked sharply upward, targeting $0.45 for Q2 fiscal 2027, stepping up to $0.51 in Q3, and locking into a premium $0.57 EPS target for late fiscal 2027 and into fiscal 2028. This monumental earnings blowout triggered a massive, violent market re-rating. Following the announcement, the stock detonated, surging over 36% in a single trading session as institutional capital flooded into the equity. The catalyst was absolute insider conviction, with management aggressively raising full-year targets alongside the strategic acquisition of the Natoma MCP Gateway. However, with the price now soaring over 100% in less than 2 months, the risk of sudden, aggressive short-term profit-taking and technical pullbacks remains exceptionally high. Even so, Wall Street analysts are scrambling to catch up, setting a normalized one-year price target of $287.16, while the maximum hyper-bullish consensus reaches a premium $500. Out of 53 active analyst ratings, a dominant 41 maintain a definitive strong buy, with a $9.2 billion backlog acting as a concrete structural floor. Snowflake is undeniably architecting the enterprise AI era. Disclaimer: for informational purposes only, not financial advice. Do your own due diligence. If this institutional breakdown gave you an edge today, hit like and subscribe. Thanks for watching, and see you in the next breakdown.